The next type of annuity we're looking at is relatively new. It's a pretty niche part of the annuity marketplace. These are qualified longevity annuity contracts, or QLACs for short. These were just created about 10 years ago and then recently had a change from the Second Secure Act a couple of years ago that made them a little bit easier to use and easier to implement into a plan. And so these are a type of deferred income annuity where you're still putting up a big one-time payment now, but in exchange, that monthly income doesn't begin until a later date. And what makes these in particular unique is that the payments can be delayed until as late as age 85, and you do not need to take RMDs or required minimum distributions on the amount that's in a QLAC. You're limited to only being able to put $200,000 per person in these. That amount is adjusted for inflation, so it'll go up over time. And so you can't kind of do this with a $1 million IRA, for example. Tends to be a relatively smaller piece of the big picture. And then, like I said, these are a very small piece of the insurance landscape. Here, this figure at the bottom, they make up less than 0.1% of all annuity sales. And so, why are we even taking our time to discuss these? It just so happens that these can be one of the best ways to protect a retirement plan from that risk of longevity or outliving your assets. And just to start to show why, here's an example of a 65-year-old male today who wants to purchase a $200,000 QLAC and have the payments begin at age 85. I'm using 65 here again just to try to keep consistent, but there is, these are something that can be available at really about any age. I guess maybe not past 85, but there is no limit. It doesn't have to be 65, just so we're clear. But again, just for kind of continuity in this example, this person could pay $200,000 today, and then beginning at age 85, they would get a payment of just over $10,000 per month, so $120,000 per year. This payout comes with no kind of minimum payments or guarantees. So if you die at age 85, you're not getting a big lump sum back. There is an option here to kind of guarantee at least your initial principal, meaning your heirs or beneficiary would get at least that $200,000 back. That would reduce your payment to about $8,500 here. So you get about $1,500 a month less if that's something you really want to protect against. But right away, I hope you see that these have the potential to really guarantee large amounts of fixed income later in life if you're comfortable with that trade-off of potentially passing away early and not getting this money kind of into your estate. And so what are some of the pros and cons of these? Again, these are annuity contracts. They provide you with a very known return. There's no uncertainty on these about what the stock or bond market has to do to give you that income. And then, I think the pro that's most important here is that there's almost no better way to protect against longevity and outliving your assets than a QLAC. We're going to look at some specific numbers in a second, but if you somehow knew you were going to live to be 100 years old, the math behind QLACs just makes them incredibly tough to beat. And so now, just before we get into some examples, there are a few potential drawbacks, just to be clear. These are irrevocable contracts as well. Once you send over that $200,000 or whatever amount you choose, there is no getting it back, until you live long enough to get your payments started. And that means if you pass away earlier, these investments will end up producing, low or poor return compared to if you just kept it invested in your IRA. There's inflation risks with these, like any other fixed income. Like before too, guaranteed by an insurance company is a good thing, but it is not risk-free. And then lastly, you're purchasing these with pre-tax money, so any payments are taxed as income, and so you're going to force a certain amount of taxable income on you later in life, and potentially remove some options of taking advantage of tax breaks for those with lower taxable income. It's not always a downside, but again, just it could be for some. And so what's important to consider is knowing the trade-offs you're making with a QLAC purchase. And the alternative is just keeping that money invested and hoping it grows enough to support withdrawals for as long as you live. Just to give you some numbers to see how QLACs compare with just investing in general, here's a scenario where that same 65-year-old invests that 200,000 instead, or likely just keeps it invested and begins withdrawing at age 85. And so just to start, we'll assume a 7% annual return on that $200,000. That grows for 20 years and would become about $775,000 in 20 years. They then would begin the $10,000 monthly withdrawals, which would cause their investment account to be depleted somewhere around age 92. That's shown in the green line in this chart here. And then I also wanted to show some variable return just to see how that affects the math here. And so the red line shows a 9% annual return. That would support similar withdrawals that you could get with the QLAC through age about 101. But just note that 9% returns is pretty optimistic and certainly higher than an average retiree portfolio has achieved over long periods of time. And so definitely on the optimistic side for what you might want to plan on. The blue line here is 5% returns, which would give you that same income that the QLAC would pay out through just about age 88. It's just about a month or two shy of age 89. I think this blue line might be worth focusing on because today long-term investment grade corporate bonds have a yield of about 5.5%. And so getting anything much more than about 5.5% today means at the very least just taking on more risk than you would with an annuity contract. But kind of think of this as your break even for a 65-year-old delaying income until age 85. It's probably, late 80s, early 90s is the break even just to have in your mind. And so right away, you see that if you want to protect against longevity, right, if you knew you were going to live until 100 years old, QLACs are really great just because we would never, want to plug in a 9% or even higher annual return for a retiree for the next 40 years. It'd just be a little bit tough to bank on. And so these QLACs can provide that return for people that live that long, and so are a great way to protect against longevity. The third bullet point here is just another benefit worth mentioning. And it's very common to, retire at 65 or whatever age you retire and feeling a little nervous to spend money. It's hard to comfortably spend early on when you just don't know how long you need to preserve your assets for, right? Do we need this nest egg to last for 20 years or 40 years? And QLACs can give you that confidence to spend early on, because you've already secured some amount of income for later in life. So now your planning window has shrunk. We set aside money in a QLAC to create fixed income that meets your goals at age 85 and later. Now we just need to make sure that what's left, lasts you from now until age 85 or whenever the QLAC income kicks in. So it can help reduce some tail risk of the plan, but you have to be comfortable with the costs here. If you pass away before a certain age, you're likely going to either leave a lower inheritance or just have a lower return on your money than if you kept it invested. One last example I just wanted to introduce here is how a QLAC can compare to one of the most popular forms of long-term care insurance, which is called a hybrid long-term care policy. With a hybrid long-term care policy, you're making a big payment upfront to secure income in the future in case you need long-term care. These policies get really complex. I'm showing some details here of a policy we just saw a couple months ago for a 65-year-old male. But maybe just at a very high level, this policy required a payment of $153,000. And in return, it would pay ultimately a payment of about $10,800 per month for someone age 85 who was in long-term care. And so a pretty close payment to what we were looking at with that QLAC a bit ago. And the policy, as all long-term care policies sold today do, has a maximum benefit amount. There's some kind of cap in what they're going to pay out. This one, for example, had a 4-year payout. And then again, just to emphasize, this only pays out if you are in long-term care, kind of meet the qualifications to be able to claim on that policy. And I think this is worth considering a QLAC for instead of a hybrid long-term care policy in some instances, just because when you look at the demographics of who needs long-term care, it tends to be those over age 85. That's about the time that QLACs can kick in for maximum benefit. And then also the big concern a lot of people have with long-term care is not needing it for 1 or 2 years of care, but those cases like dementia, for example, that can lead to many years of very high level, high cost care. This makes up about 1/3 of people in long-term care today. And in that case, the case that a lot of people really worry about and what is the risk for most clients' plans, that we see today is just long-term care policies don't help as much just because those payoffs are capped at a certain amount. And so, again, we're going through some details here pretty quick. Going through these policies line by line would take quite a while. But just to try to summarize a side-by-side comparison, long-term care policies might cost a little less than a QLAC for the same benefit, but they only pay out in the scenario where you need long-term care. And so that makes a lot of people hesitant to buy this type of insurance because, they don't want to pay into, hundreds of thousands of dollars into this and be healthy and not get their money out, right? And so the benefits are also capped. And so if you need long-term care for many years, these policies won't fully cover you. QLACs, on the other hand, pay as long as you're alive. So if you're healthy, you're still getting that $10,000 a month payment in our example. If you need long-term care, you're still alive, and so you're getting that payment, which goes a very long way towards paying towards your long-term care costs. And so again, I know we kind of ran through this example really fast. I would just say before you plop down hundreds of thousands of dollars on a hybrid long-term care policy, it's at least worth considering and comparing a QLAC to that because payment amounts can end up being pretty similar. And so just, maybe ultimately to summarize here, remember that both these products we talked about today, SPIAs and QLACs, are insurance. Insurance of any type has some kind of fee to it. When you buy insurance, you are accepting a potential for a lower return in one scenario in exchange for protection against the cost of another scenario. And so it's about determining what risks you're comfortable taking, what risks you don't want to take, and acting accordingly. If you know the prospect of potentially leaving a couple $100,000 less in an inheritance is not as big of a concern compared to what you have about outliving your money, a QLAC is a really great choice. If the potential of buying into these though is buying into these and then potentially not seeing a return is something you just can't get over, that's fine too. You just, now you're managing a little bit of longevity risk now compared to, someone that did purchase a QLAC. And so, like always, it's worth thinking about the pros and cons, and we're, of course, here happy to help. We can use some planning software to help you think about risks that are there in your plan. and make some recommendations accordingly. So thank you so much for your time today. Hopefully this was helpful introduction just to a couple of interesting options out there today. Please know that we're happy to talk in more detail with you personally if anything here sounded interesting. We're here for questions if you have any, and if not, thanks again and have a great weekend.